The information presented should not be construed as legal, tax, accounting, or any other professional advice. You should consult with your accounting, tax, or other professional advisor familiar with your particular factual situation for advice concerning specific tax or other matters before making any decision regarding how to track or account for your software expenses. Welcome. My name is Katherine Edenbach, and I am the CFO of CAI Software. I wanted to talk to you today about the differences between capital expenditures, more commonly referred to as CapEx, and operating expenditures, or OpEx, and especially how they relate to software purchases. If you think about capital expenditures, they are a one-time purchase of a major physical good or service that is intended to benefit the organization for more than 1 year. In comparison, operational expenditures are recurring expenses incurred to support the day-to-day operations of a company. Capital expenditures are recorded as an asset on the balance sheet and depreciated or expensed over time based on the asset's useful life. The asset's useful life is determined based upon how long the company plans to use the asset. So if the useful life of the asset is 5 years, it's going to hit the P&L over a 5-year time horizon as opposed to hitting the P&L all at once. CapEx can impact cash materially, but only impact the income statement or P&L through depreciation. So it's really important to understand CapEx and OpEx and how they differ, because these accounting models have a big impact on IT spending and budgets. Some examples of IT capital expenditures are servers, routers, data centers, computers, printers, and on-prem or legacy software licenses. From an IT perspective, some examples of operational expenditures would be contracts for website hosting, annual maintenance, and service agreements. In addition, cloud computing and as-a-service offerings have changed the cost model for many IT products and services, enabling them to be more readily classified as OpEx rather than CapEx. The rationale for this is that you're not purchasing something up front, but paying for it over time. With operational expenditures, there are different types of benefits. OpEx typically has a lower upfront cost, or maybe pay as you go, leaving you with more cash for other needs. You also can purchase a smaller number of users up front and then add access as your company grows. And maintenance for SaaS products is handled by the vendor instead of your own internal team. Adopting cloud services may increase costs over time. However, that is mitigated a bit by the fact that you're paying for the solution with smaller expenditures over a longer period. As we discussed earlier, CapEx needs to be considered from both a cash perspective and how that depreciation or expense will roll in and hit the P&L over time. OpEx has a bigger impact to your P&L in the short term because you're paying for the operational expenditure as you use it. It's also important to understand how your OpEx expenses might grow. For example, if you start with a smaller number of users for a product, but plan on increasing that over time, you would need to make sure that you increase those costs in your budget as you move through the year. So for our listeners, you really need to take a step back and look at your IT needs, what you're going to be purchasing now and in the future, and whether those are better suited as CapEx or OpEx for your company from a business need, and then also from an accounting and budgeting standpoint.